One of the big buzzwords in business in 2021 is inflation. Are we going to have inflation? Is it going to be runaway inflation? How's it going to affect markets? How's it going to affect the economy? And in the insurance industry, inflation actually has some effects that may not be as obvious in other areas. Insurance Journal has a great article about this that came out a couple days ago. Inflation specter looms, they called it. And this sounds kind of ominous. In reality, it kind of is. The first part of the article defines inflation and what the history is, and I don't think we need to get into all that. The main thing is, what does this mean for property and casualty? And it brings up a couple very good points. First of all, liabilities. Insurers prepare for liabilities in the form of loss reserves, meaning that they collect premiums on policies over many years from many different insured, and if they have a loss, they figure what the cost is going to be, right? If a building burns down, it costs $100,000 to repair it. If there's a vehicle that is totaled, it's going to cost this much to replace it. Well, those loss reserves are based on a standard inflationary model, 1 or 2% a year, 3% a year, whatever it is. If they've only collected premiums on a pre-inflationary basis, cost basis, and the cost of the claim is going to be paid out on a post-inflationary cost basis, the reserves may not be sufficient, right? Unless the reserves are invested in a inflation-adjusted means. For example, if it's in stocks and the stocks go up the same rate as inflation, or real estate, it might be okay. But it also talks about the impact of inflation varies by line of business. If it's commercial lines versus property and casualty, personal lines, that kind of thing. An increase in 1% of inflation can raise the property and casualty industry by 2 to 3 points. So it's a magnification, it's a multiplication of inflation. So whatever inflation goes up, the loss claims ratio is going to be higher. For personal lines where liabilities are short, it might not be as big of a factor because those liabilities happen closer to when the premiums are paid. Talk about commercial lines, long tail. You have claims made and occurrence made, claims made and occurrence made type policies. You have medical professionals. You may actually have a 1% hike in inflation may increase the ratio by more than 5 points because those claims may happen 4 or 5 years later, or a product type policy. Another area where it might come into play is pricing. Insurers charge prices today that will pay for future claims. If inflation proves to be greater than anticipated, insurance may not have sufficient funds. So they may have to re-rate some of these policies and some of these premiums. Sometimes, for example, on work comp, 50% of medical payments and 50% for loss of wages. If the CPI jumps, then that trend can even jump even higher. Another example where they talk about it could have an effect of investments. Most of the investments for at least property and casualty are in treasury and low performance type bonds, but they're safer. These assets don't necessarily peg to inflation. A lot of times right now bonds are actually not very well appreciated by the market because they don't really take into account inflation. If they can switch to higher yielding bonds, well, then they might have to do two things. First of all, book losses on the old bonds, but also be at more risk. So the regulators that govern the books for these insurers may not look very highly on some of these higher risks. As an insurer, you have to kind of juggle both ends, making sure you have enough reserves to handle potential runaway inflation, but at the same time having safe enough investments where you can maintain your balance sheet. As a insurance producer, you have to keep in mind, what does this mean for your clients? What does it mean for the market? Is it going to harden up the market on rates? Do you have to maybe reshop different markets for your clients and for your insureds? And if you're an insured, especially if you're a commercial lines client, you have a company and you have different business lines, you may want to expect that your insurance component of your profit and loss statement, you may want to look to increase the percentages because some of these policy premiums may be increasing more than the CPI increase because the insurer has to lead the market. They have to be prepared for higher insurance. So this is a great article about inflation, how it affects insurance, and how all the players and all the stakeholders, whether the insured, an insurance company, provider, different markets, and also the insurance producer, may be affected by inflation in the future. And those who think about it in advance and plan accordingly will be in better shape to handle the changes in the market.